Hello everyone, and Miss Elvia. Thank you for your time. We from Group 11 will present a case about Gojek. The title is GoTo Efficiency Move. Are Gojek Tokopedia layoff a necessary step or a step back? Hopefully, what we convey can provide new and interesting insight to discuss. Let's get started. Our group member consists of Larasati Agrifina Aulia, Fenia Laurencia, and Fitriandana Aulia Nurti. This is the content that we will discuss in this video. So we started with the case. First is the case. The case that we will discuss is the case of Tokopedia, where Tokopedia is implementing efficiency in running its business. The main goal of PT-GoTo, Gojek Tokopedia Tbk, in 2023 is to achieve profitability without having to make further layoff. Although there have been previous workforce reduction in 2022 and 2023. Under the leadership of CEO Patrick Sugitowaluyo, GoTo has shifted its focus to aggressive cost-cutting measures, especially on cost-related technology, while you emphasize the need for efficiency while ensuring that there will be no additional layoff, which marked a clear departure from previous layoff. GoTo's focus on reducing operating costs and optimizing technology costs reflect a broader strategy to navigate challenging market conditions while maintaining service quality. The company has seen significant reduction in other areas, including marketing and general administration costs, which have allowed it to stabilize its finances. But despite the cost efficiencies, innovation remains a key pillar of GoTo's approach, with recent product launches and ongoing development of new services. These innovations are expected to support GoTo's long-term strategy as the company positions itself for sustainable growth while achieving profitability goals through disciplined cost management. Okay, next is company background. The company name is PT GoTo, Gojek Tokopedia Tbk. The established date is December 11, 2015, and exchange at Indonesian Stock Exchange. Listing date-nya at April 11, 2022. The stock code is GoTo. Listing board-nya is New Economy Board. And the total employees of GoTo Group is 7,522 permanent employees. This is the PT GoTo's milestone, and this is the continuation of PT GoTo milestones.
Okay, the next is part 3 about the theoretical framework. For the financial reporting quality, we use three indicators, which is 1. Decision useful information, which refers to information that provides relevant insights and data to help stakeholders make informed financial and business decisions. The second is faithful representation of economic reality, which refers to financial statements that accurately depict the underlying economic events and conditions of a company, ensuring reliability and transparency. The third is compliant with standards, which refers to financial reporting that adheres to established accounting principles and regulatory guidelines to ensure consistency and comparability. For financial statement quality, we are also use three indicators, which is the first is earnings quality, which refers to characterized by being sustainable, reliable, and free from excessive manipulation, reflecting the company's true operating performance. For balance sheet quality, financial stability with accurate reporting of assets, liability, and equity, supported by low leverage and strong liquidity. And from cash flow quality, which refers to cash flow assets that the consistency and sustainability of cash generation from core operations, indicating a company's liquidity and financial stability. For financial statement analysis, we are using three key tools. The first is common sense analysis, which includes vertical analysis that evaluates financial statements by expressing each line item as a percentage of gross revenue for a given period and allows comparison with competitor performance. And horizontal analysis, which evaluates financial statements by expressing changes on each year as a percentage. The second tool is trend analysis, which evaluates financial statements by expressing each line item as a percentage of the base year, highlighting trends in financial statement items over time. Lastly, we use ratio analysis, which includes activity ratios to assess how efficiently a company conducts its daily operations, including the collection of receivables and inventory management. Liquidity ratios, which evaluate a company's capability to fulfill its short-term financial obligations. Solvency ratios, which determine a company's ability to meet its long-term financial commitments, with subsets often referred to as leverage and long-term debt. Profitability ratios, which gives a company's ability to generate profit from its resource, and valuation ratios, which indicate the value of an asset or cash flow, such as earnings, linked to ownership of a specific claim, like a share or stake in the company. Part 4, Application of the Theoretical Framework.
Okay, first of all, we're gonna talk about the financial reporting quality of GoTo based on the independent auditor's report published by KAP Purwantono, Sungkoro, dan Surya. Consolidated financial statement of PT GoTo, Gojek Tokopedia Tbk, present fairly in all material respects. The consolidated financial position of the group as of 31 December 2023 and its consolidated financial performance and cash flow for the year ended in accordance with Indonesian financial accounting standards. There are three aspects of financial reporting quality. The first one is decision useful information. The financial statements of GOTO enable stakeholders such as investors, creditors, regulators, and management to make informed and effective economic decisions. By knowing the relevant financial information, stakeholders could evaluate the company's performance. For example, by knowing that GOTO total gain or loss for the years, investors could determine whether or not they should invest in the company. Creditors could assess the company's creditworthiness before giving out loans, and management could decide what strategy the company should implement based on its financial performance, such as laying off employees to increase its operational efficiency and other efforts to increase gain and minimize loss. Next is the faithful representation. GOTO's financial statements ensure faithful representation through comprehensive disclosure, neutrality, and freedom from material error. The company's annual report provides comprehensive disclosure covering a full range of information such as corporate performance overview, management reports, company profile, management analysis, corporate governance, corporate social responsibility, and detailed financial statements. GoTo presents its financial information in a transparent and unbiased manner, reflecting the actual state of the company as confirmed by an independent auditor. Furthermore, the financial data is free from material misstatement, upholding its reliability for users, which aligns with GoTo's commitment to accurate and fair reporting. Lastly, is the compliant with standards. GOTO's financial statements are prepared in accordance with the applicable financial standards in Indonesia, which are also known as PSAK. By complying with these standards, the financial statement provide the consistency expected by stakeholders that allow them to assess the company's overall financial performance. Adherence to relevant accounting standard ensures the sustainability of Goto's financial reporting throughout the year. This consistency allows for comparison of financial statements over time, which enhance understanding of the company's progress and facilitates data-based strategic decision making. Furthermore, compliance also protects the company's reputation, reducing the risk of whistleblowing and ensuring transparency and accountability for stakeholders. GoTo's financial reporting quality is relatively high with characteristics that match the position of Tier 2 from the financial reporting quality spectrum. Firstly, it is in accordance with accounting standards. Secondly, it contains decision useful information relevant to making informed and effective economic decisions. However, the sustainability of its earning is questionable. Goto has low earning quality because its earnings are not sustainable and are heavily impacted by large non recurring items which distort the actual performance of the business. Moving on, we're gonna analyze deeper the earnings quality of Goto. Based on its income statement, Goto's net revenue have an overall positive trend from 2020 to 2023, with an increase of 36.30% in 2021, 150.22% in 2022, and 30.28% in 2023. The rising trend indicates the firm's effort to improve the earnings quality by increasing gross revenue, which they do in 2021 and 2022, and decreasing gross revenues reduction, which they do in 2023. This shows that Goto is successful in its effort to improve its operational capacity to generate revenues. Next, there is an increasing gross profit margin. So, although there is a decrease in gross profit margin in 2021, Goto continuously increases its gross profit margin, and by 2023, the margin reaches 60.94%. This shows the firm's effort to improve its earnings quality by increasing the effectiveness of their revenue generation, including capturing more demand and reaching more customers. Moving on, there is a decline in total expense in 2023. To increase its efficiency, Goto reduces its expenses, including sales and marketing expenses, general and administrative expenses, and product development expenses, as can be seen from the sharp decline of 39.86% in total expense in 2023. However, Goto's total expense still exceeds its net revenues, meaning that Goto is facing loss. Although Goto still faces loss, this effort to increase efficiency help lessen the loss. Next, there is a sharp decline of loss from operation in 2023. In 2021 and 2022, Goto continuously faces an increasing loss of 120.17% and 35.49% respectively. But in 2023, it faces a sharp decline of loss of um, minus 66.11%. It indicates that Goto is trying to fix its operational inefficiency and poor earnings quality by pushing its expenses and increasing its revenues. This aligns with Goto's decision to lay off employees and cut off many expenses to stay afloat in the market. Furthermore, although Goto increases its operational efficiency, especially in 2023, there is a major increase in loss from other income or expenses. This suggests poor performance from Goto's non operational sector. For example, financing activities and goodwill impairment that leads to 124.01% increase in loss in 2023. As stated before, from these findings, we can conclude that GoTo's earning quality is low because it is not sustainable and is heavily impacted by large non recurring items that distort the actual performance of the business.
Okay, next is balance sheet quality. From the debt to equity ratio of PT Goto, we can see that the score is 1.13, which is lower than the industry average and sector. This is indicating that the company is taking a more conservative approach in using debt, and we can conclude that the PT Goto have lower leverage level. And next, from the current ratio of PT Goto, which score is 3.2, and quick ratio is the same 3.2, we can uh, which is the higher than the industry average and sector. So we can conclude that the PT Goto have adequate liquidity to meet the short-term obligation. Next is from the return on asset of PT Goto and return on equity of PT Goto. We can see that the two ratio have score is below than the industry average and sector. So we can conclude that the PT Goto asset allocation in 2023 was economically unsuccessful in generating positive return. And from overall explanation, we can see that in 2023, PT Goto has very good liquidity, but low leverage and poor asset allocation efficiency in generating profits indicate weakness. So therefore, it can be concluded that the quality of PT Goto balance sheet in 2023 is still weak and need to be improved in order to achieve a stronger and more optimal financial position.
From the cash flow quality, based on operating and investing activities, Goto has struggled with negative cash flows from operating activities, though there was improvement in 2023, reducing outflows to 4,325,308 million rupiah from 17,206,303 million rupiah in 2022. The variability in investing cash flow from large inflow in 2022 to negative outflow in 2023 suggests an adaptive investment approach. Yet this ongoing cash outflow indicate the company still faces challenges in generating sufficient cash internally. From the financing activities have been crucial for Goto, particularly with a significant cash inflow of 121,530,628 million rupiah in 2021, helping to offset operating and investing outflows. However, 2023 saw a reduction in financing inflow to 1,732,508 million rupiah, paired with declining year-end cash reserve from 31,150,908 million rupiah in 2021 to 25,143,935 million rupiah in 2023. This trend highlights a gradual reliance on internal cash reserve, which could impact liquidity if operating cash flows don't improve.
Okay, so for the first analysis, we're gonna do the horizontal analysis of the GoTo's financial statement. So, first up, we're gonna explain the horizontal analysis of GoTo's income statements. There is some important points that we could highlight in this analysis. Firstly, the decline in gross revenues growth. Although the gross revenues continually increase, the growth percentage is declining from 80.40% to 5.82%. The reason behind this is similar to the theory of the law of diminishing return, where if Goto continually increases its demands captured, there is less demand that can be captured, which eventually leads to a smaller increase in growth percentage over the years. Next, there is a major decrease in incentive to customers. Goto is actively decreasing its incentive to customers by reducing its growth percentage in 2022 and reducing it even more in 2023. In fact, in 2023, Goto managed to not just decrease the growth percentage but decrease the expense altogether by minus 18.16%. This trend shows the company's effort to increase its net revenues by cutting unnecessary expenses, which in this case the incentive to customers, and improving its efficiencies. Next point is that there is changes in net revenues trend. The net revenues growth is quite fluctuating as it faces a significant increase in 2022. Albeit its constant growth, 2022 may face the highest increase due to a major increase in gross revenues and a decrease in the incentive to customers compared to 2021 and 2023. This this pinpoints 2022 as the year where Goto undergoes many efforts to improve its professional operational profitability. Next, there is a significant decline in total costs and expenses. The decline in total costs and expenses aligns with the company's strategies. The overall decline shows that the company is aiming to increase operational efficiencies by doing cost cutting measures in 2023. Goto has continually decreased its growth percentage in its sales and marketing expenses from 250.57% to minus 54.35%. General and administrative expenses from 99.15% to minus 55.55%, and depreciation expense from 93.76% to minus 8.30%. Product development and operational support faces an increase in 2022 before declining dramatically in 2023. Goto's effort this shows the Goto's effort to solidify innovation as its pillar by pushing technological improvement, which leads to cost increase in 2022, and in 2023, Goto started to focus on cutting technology related expenses, as been stated in the case beforehand too, which lead to cost decrease in 2023. Next point is that there is a decrease in loss from operations. So, although it continually faces loss from operations, Goto managed to lessen its loss over the year. In 2023, Goto faces a significant decline of 66.11%. This gradual decrease in loss is accumulated by Goto's effort to improve its efficiencies, both by increasing the revenues and decreasing the costs. Next important point is that there is a fluctuative trend in foreign exchange, where Goto faces an extreme rise in foreign exchange gain in 2022 for 4,925.47%, but later on faces a foreign exchange loss in 2023. The main reason for the high volatility is the economic instability that resulted in the ever changing currency exchange rate. Furthermore, the status quo is filled with many global tensions and rift between countries. The political instability also worsened the economic volatility. Next, there is a major growth in loss on goodwill. The rising trend of loss on goodwill that reached 615.82%. The possible reasons behind this includes first, there is an overvaluation during the merger, followed by downturn in market conditions. So When Gojek and Tokopedia merged, the valuation of assets, including goodwill, was recorded based on projected future benefits from the combined operations, potentially inflated by market excitement surrounding the merger. However, subsequent downturns in market condition may have revealed that the assumed value of goodwill was far higher than its actual economic worth. This mismatch resulted in a substantial impairment of goodwill. Second, there is an underperformance related to the original post merger expectations. Following the mergers, Goto's financial performance did not meet the ambitious projections set during the deal. Challenges such as increased competition, operational inefficiencies, and slower than expected revenue growth undermined the expected synergies, directly impacting the valuation of goodwill. And lastly, damage to the company's reputation, potentially due to the loss that Goto endured in the past few years. These ongoing losses have weakened the investors' confidence and lowered the company's overall valuation. Next is the volatility of fair value adjustments of financial instruments. So there is a significant increase in the fair value adjustment of financial instruments in 2022 of 22,965.30%, which was followed by a major decrease in 2023 of minus 280.40%. The possible reasons behind this is that first, the changes in market conditions. The sharp rise in 2022 could be linked to favorable market conditions such as declining interest rates that temporarily boosted the value of Goto's financial instruments, and conversely, in 2023, rising interest or unfavorable economic trends may have significantly reduced the market value of these instruments, leading to the steep decline. The next reason is that Goto faces deterioration of credit worthiness due to financial challenges and ongoing losses. Hence, the market may assign a lower fair value to the instrument because the higher perceived risk of Goto. Okay, lastly is that there is an overall increase in loss for the year. Goto's loss for the year continually increased due to rising non-operational expenses over the years, such as from goodwill and fair value adjustments of financial instruments. So, from this horizontal analysis of income statement, there are some important points that we could conclude. The first one is that Goto's total comprehensive loss progressively increases with a peak of 124.53% increase of loss in 2023. And even though Goto successfully increased efficiency and minimized loss from operations, Goto's other losses from non-operational activity kept on increasing, which raised Goto's total comprehensive loss over the years.
Okay, the next is horizontal analysis for balance sheet. So, in this segment of asset, we can see that there is increase in cash and cash equivalent. Cash and cash equivalent increased significantly in 2021 by 103.34% compared to 2020. This increase reflects the company's increased liquidity. However, in 2022, there was a decrease of 6.8 in 88%, followed by a further decrease of 13.32% in 2023. This decrease may indicate a reduction in liquidity that may be used for debt payment or strategic investment. Overall, we can see that there is increase in current asset. A significant increase in current asset occurred in 2023 2021 with an increase of 84.70%, indicating an increase in liquidity. However, this increase was followed by a decrease in current asset in 2022 and 2023. This indicates that in 2022 and 2023, PT Goto experienced a decrease in liquidity compared to 2021. Next is from the segment non-current asset, we can see that there's significant increase in non-current asset. Total non-current asset in PT GoTo experienced a very significant increase in 2021, which was 1,025.15%. This significant increase in non-current asset was due to a significant increase in goodwill. In 2023, PT GoTo's non-current asset experienced a drastic decline of minus 81 80.50% due to a decrease in goodwill of minus 95.9%. Next is the current liability segment. From the segment, we can see that there was an increase in escrow and other payables for third parties of 228.68% in 2022. This increase indicates an increase in PT GoTo's obligation to third parties. Besides that, there was in 2021, there was an increase in accruals of 243.779%. This significant increase indicate an increase in unpaid costs such as salaries, interest, or other obligation. Uh, in overall, we can see that there is increase in current liability. Total current liability PT GoTo experienced a significant increase in 2021, which was 113.29%. This increase was due to the increase in escrow and other payables and accruals. The condition indicates greater financial pressure on PT GoTo regarding payment obligation to external parties. Next is the non-current liability segments. From this segment, we can see that in the period of 2020 to 2023, the company show a dynamic debt management pattern. In 2021 to 2022, there was a significant decrease in non-bank loans, reaching a zero in 2022. Conversely, in 2022, there was increase in bank loan after previously no bank loans were recorded in previous years. Furthermore, in 2023, there was a decrease in bank loans followed by a significant increase in non-bank loans. These changes reflect that PT GoTo tends to focus on using one source of debt funding alternately between bank loans or non-bank loans, according to the company's funding needs and strategies. Next, from the equity segment, we can see overall there is decrease in total equity. In 2021, total equity increased but was followed by a significant decline in 2022 and 2023. Although share capital and additional paid-in capital continued to increase each year, total equity as a whole continued to decline due to PT GoTo's accumulated loss, which continued to increase from year to year.
From horizontal analysis of cash flow, especially on operating activities, we have identified three major things that happen in this activity. The first is significant improvement in cash operations. GoTo's net cash used in operating activities decreased substantially in 2023, dropping to Indonesia rupiah 4.3 billion from Indonesia rupiah 17 billion in 2022, a 74% improvement. This reflects enhanced cost control and reduced inefficiencies. The next thing that happened is reduced payment to customers and other. Payment to customer decreased by 36% and payment to other dropped by 39% in 2023. This reduction suggests GoTo implemented cost-cutting measures, potentially reducing incentive and discounts. The next is slowing revenue growth. While received from customer increased to 23 billion in 2023, the growth slowed to 3.70% compared to 48% in 2022 and 82% in 2021. This indicates challenge in sustaining customer acquisition and revenue expansion at previous levels. From investing activities, we have identified three major things that happen. The first is sharp decline in net cash from investing activities. GoTo's net cash from investing activities shifted drastically to a negative Indonesia rupiah 1.4 billion in 2023, from a positive Indonesia rupiah 1.1 billion in 2022, reflecting a negative 229% change. Reduce inflow from asset sales and increase outflow for various investment. The next is the increase in cash release due to loss of control in subsidiaries. Cash release due to loss of control in subsidiaries surged by 226%, rising from Indonesia rupiah 58 billion to Indonesia rupiah 190 billion in 2023. This suggests GoTo divested or restructured certain subsidiaries, further impacting cash flow negatively. The next thing happened is reduction in asset purchase and investment. Purchase of intangible asset and fixed asset decreased significantly in 2023 by 53% and 50% respectively compared to 2022. Similarly, addition to investment in associate and joint venture dropped sharply by 84%, indicating a pullback in expansionary spending. From financing activities, we also identify three major things that happen. The first is significant decline in net cash from financing activities. GoTo's net cash provided from financing activities dropped by 87% from Indonesia rupiah 13 billion in 2022 to Indonesia rupiah 1.7 billion in 2023. This sharp decline is primarily attributed to reduced proceeds from share capital issuance and lower borrowing activity. The second is decreased loan repayment activity. Repayment of loans from third parties decreased by 70% from Indonesia rupiah 1.5 billion in 2022 to Indonesia rupiah 456% billion in 2023. This reduction reflects a scaling back of debt servicing, potentially due to reduced loan inflows. The next thing that happened is increase in capital injection from non-controlling interest. Capital injection from non-controlling interest increased significantly by 138% from Indonesia rupiah was 11 billion in 2022 to Indonesia rupiah 27 billion in 2023. This indicates improved external support despite a general decline in financing activities.
Okay, so next we're gonna do the trend analysis of GoTo's financial statements. Firstly, we're gonna do the trend analysis for income statements. There are few important points from this analysis. First one is increase of gross revenues. There is an increase of 288.27% gross revenues in 2023. This indicates that the company tries to expand the scope of its customers and increase the demand captured by implementing strategic initiatives such as expanding services, enhancing marketing efforts, or leveraging partnerships and boost overall revenue generation. Next is the changes in incentive to customer. So the incentive to customers increased in 2021 and 2022 but decreased in 2023. The increase of incentive to customer aims to increase customers' engagement and the decrease in 2000 2023 shows the company's effort to lessen company's loss and improve net revenues by cutting back on discretionary expenses. Next is the increase of net revenues. So the net revenues in 2023 increased by 444.29% due to the increase of gross revenues and the decrease of its deduction, which is the incentive to customers. This combination reflects the company's focus on enhancing revenue generation while optimizing expenses to improve profitability. Okay, next point is that there's changes in total cost and expense. As explained before in the income statement horizontal analysis, GoTo's cost and expense increased in 2021 and 2022, but decreased in 2023. We're going to do some breakdown regarding these changes. First, the increase in 2021 may be caused by enhanced technological improvements and marketing efforts aiming to scale the business and enhance customers' acquisition. However, in 2023, Goto adjusted its strategy by focusing on increasing efficiency and reducing costs. This included streamlining operations, optimizing resources, and implementing cost saving measures such as workforce reductions through employee layoff. These changes reflect the company's proactive approach to managing expenses in response to shifting market conditions. Uh, Although Guto used different approach in 2022 and 2021, which focused on getting more revenue compared to 2023, where they focus on reducing costs, they ultimately aims for the same target, which is to improve Goto's profitability and long-term sustainability. Next point is that there is a decrease in loss from operation in 2023. Since 2020, Goto always faces loss from operation, continuously increasing in 2021 by 220.17% and 2022 for 298.32%. In 2023, Goto managed to lower its loss from operation to only 101.10% compared to 2022. This turnaround was driven by increased net revenues supported by higher customers' engagement and reduced customers' incentive, and a decline in overall costs and expenses. By focusing on efficiency and optimizing resources, Goto has managed to significantly improve its financial performance. Moving on to the last two point, which is the major loss from fair value adjustment of financial instruments and significant rise in loss on goodwill. So Goto faces major loss from fair value adjustments of financial instruments, which in 2023 increased 1,913.8% from 2020. This shows that the interest rates in the market are very volatile, as explained in the income statement horizontal analysis before. And lastly, in 2023, Goto endured significant loss on goodwill, increasing 3,604.31% from 2020. This means that Goto's performance falls short of the initial post-merger expectation. The more comprehensive explanation of goodwill impairment is already explained in the income statement horizontal analysis. So from this, we can get some key takeaways. The most important thing is that Goto loss progressively increases with a peak of 540.89% increase of loss in 2023. And even though Goto successfully increased efficiency and minimized loss from operations, again, Goto's other losses from non-operational activity kept on increasing, which raised Goto's total comprehensive loss over the years.
Okay, next for trend analysis for balance sheet, and this is the segment for asset. In this segment, we can see that there is changes in total current asset. PT Goto's total current asset increase in 2021 and decrease in 2023, 2022 and 2023. In 2021, total current asset were 100 87.70% of 2020. In 2022, total current assets were 175.5% of 2020. In 2023, total current assets were 172.17% of 2020. The major cause of the decrease in total asset in 2022 and 2023 was the decrease in cash and cash equivalent. Uh, Besides that, there was significant increase in corporate income taxes. There was a very significant increase in corporate taxes from 2020 to 2023. In 2023, corporate income taxes reached 4,696.46% from 2020. This significant increase may have been caused by a significant increase in PT Goto revenues from 2020. Okay, next is for non-current asset segment. From this segment, we can see that there is goodwill fluctuation. So, in 2021, there is a significantly increase from the PT Goto's goodwill. This is because the acquisition of Toko, which result in goodwill. And in 2023, there was a significant decline in the goodwill value due to the loss of PT Goto's control over Toko after TikTok became the majority owner, which caused the reclassification of Toko's asset, including goodwill, as investment in associated companies. And overall, we can see that there is changes in total non-current asset. In 2021, there is significant increase, reaching 1,125.15% compared to 2020. However, in 2022, PT Goto total non-current asset decreased to 992.51% of total non-current asset in 2020. This decline continued in 2023, with total non-current asset decreasing significantly to 193.52% of total non-current asset in 2020. Next is the segment of liability, current liability. In this segment, we can see that there is significant increase in deferred revenue. PT Goto's deferred revenue experienced a significant upward trend from 2020 to 2023, with an increase in deferred revenue reaching 479.85% in 2021 and 565.21% in 2022 compared to deferred revenue in 2020. Despite the decline in 2023, the overall trend from 2020 to 2023 shows significant growth in deferred revenue, reflecting the growth of contract or deferred revenue. Uh, Next, there is changes in total current liability. PT Goto's total current liability show a constant upward trend from 2020 to 2023. Although there was a slight decrease in 2020 compared to total liabilities in 2021. However, when compared to 2020, total current liabilities increased to 222.6 47% in 2023. Several accounts that have a large contribution and are the main drive of the increase in the value of current liabilities are trade payable for third parties, escrow and other payable for third parties, and accrual. Next is the non-current liabilities segment. From this segment, we can see that PT GoTo's deferred tax liability show a significant upward trend from 2020 to 2023. In 2021, a significant increase occurred until the company deferred tax liabilities reached 3,889.68% from 2020. However, this increase was followed by a decrease in deferred tax liability in 2022 and 2023. The decrease was not too significant, so that when viewed as a whole from 2020 to 2023, there was still an increase in deferred tax liabilities. And overall, we can see too that total non-current liabilities on PT GoTo experience an increased trend from 2020 to 2023. In 2021, non-current liabilities increased to 107.72% from 2020. Likewise, in 2022, it increased to 122.50%, 15%, and in 2023, it increased to 156.68%. This trend show an increase in the company overall long-term liabilities. Last, from the equity segment, we can see that there is changes in total equity. PT GoTo total equity has shown an increasing trend from 2020 to 2023. In 2021, total equity increased significantly, reaching 68.41% compared to total equity in 2020. However, after 2021, there was a decline in 2022 and 2023. The decline in 2023 was quite significant, so that PT GoTo's total equity was only 171.74% of the total equity in 2020. However, overall from the 2020 to 2023, PT GoTo total equity still showed an increasing trend.
From the trend analysis of cash flow, especially on operating activities, there are three major things that happen. The first is reduction in operating cash outflows. Net cash used in operating activities decreased from 100% in 2020 to 59% in 2023. This reduction highlights GoTo's focus on cost efficiency. The next is customer incentive adjustments. In 2022, there was a significant spike in costs, reaching 234%, largely due to customer payment and other expense related to marketing efforts, such as discount and free delivery. By 2023, GoTo adjusted these expenditures, lowering customer payment from 353% to 226% to align with its commitment to reduce customer incentives. Payment to others also decreased from 189% to 115%. The next is employee payment adjustments. Payment to employees dropped from 239% in 2022 to 203% in 2023, reflecting GoTo's layoff programs, which affected 1,300 employees in November 2022, followed by 600 more in March 2023. This reflects the company's focus on streamlining operational costs. From the investing activities, there are also three major things that happen. The first is reduction in cash used for investing activities. Starting from the base year of 2020, GoTo reduced cash used for investing activities from 100% to 28% by 2023. There was a positive cash flow in 2022, which did not occur in 2023. This change is largely attributed to time deposit placement totaling 2,225,788 billion rupiah, an investment that was not made in 2022. The next is shift on investment focus. Following a substantial 225% investment in associates and joint ventures, GoTo shifts its focus towards safer placements. This is evidenced by a decline in investments, dropping to 28% in 2022 and further to 4% in 2023, indicating a prioritization of secure assets like term deposits. Then next in 2021, surge on cash use due to acquisition. Despite the overall reduction trend, there was a marked increase in net cash use for investing activities, from 100% in 2020 to 1,720% in 2021. This spike reflects GoTo's major acquisition of Tokopedia, which resulted in a significant cash outflow of 92 trillion 89 billion 69 million rupiah for investing activities that year. From the trend analysis of financing activities, there is also three major things. The first is overall decline in cash flow from financing activities. Using 2020 as the base year, GoTo experienced a decrease in net cash provided by financing activities, declining from 100% in 2020 to 7% in 2023, with a significant drop from 56% in 2022 to 7% in 2023. The next is surge in cash flow due to IPO and additional effects. In 2021, Goto saw a notable surge of 511% in cash flow, driven by its IPO and the Indonesia Stock Exchange, which generated approximately 135 trillion 361 billion 6 million rupiah. This IPO also led to a share capital issuance in 2022 amounting to 13 trillion 727 billion 889 million rupiah, further impacting the cash flow. The next is strategic implications for Goto. Goto may be reducing its reliance on external capital injections by focusing on operational efficiency and better utilizing existing resources. The company can strengthen its financial position and build long-term sustainability without constantly depending on funding from investors. This approach may enhance investor confidence and increase the company's value in the market.
Next, we're gonna do the vertical analysis of Goto's financial statement. Firstly, income statements. In this analysis, we want to compare Goto's financial statements to its fellow competitor. Although Goto has different accounts in its income statement from Bluebird's due to Goto's more holistic line of products as fellow transportation companies, the two are comparable. For this comparison, net revenues are used because Bluebird did not disclose their gross revenues in their annual report. So, vertical analysis talks about composition of the financial statements. So, the biggest composition of Goto's income statement in compared to net revenues included first a loss for the year of minus 612.21% and loss before income tax of minus 613%. Next is the loss on goodwill of minus 532.74%, and lastly total cost and expense of minus 169.52%. These figures highlight the challenging performance of Goto, where the majority of the company's financial composition is losses or in negative amounts. The substantial losses in key areas reflect ongoing struggles in achieving profitability, despite efforts to manage costs and boost revenues. To further analyze Goto's performance, we compare Goto's income statement with Bluebird as a competitor. Firstly, from gain or loss from operations. In 2023, there is a stark contrast between Goto and Bluebird in terms of financial performance. While Goto faces a significant loss from operations with a composition of minus 69.52% of net revenues, Bluebird achieved a gain from operations at 12.23%. This creates a notable gap of 81.75% between the two companies. Despite Goto higher net revenues, Bluebird demonstrates greater effectiveness and efficiency in its operation. By managing costs more effectively and optimizing operational processes, Bluebird is able to generate positive returns, whereas Goto struggles with maintaining profitability due to rising losses and lower operational efficiency. This highlights the importance of operational efficiency in sustaining financial performance, even when the revenue levels are high. Next is the other income and expense aspect, which is another major difference between Goto and Bluebird's performance because Goto faces other expense of minus 0.35% of its net revenues that further increase Goto's loss to minus 612.21% of its net revenues, while Bluebird gains some other income of 1.22% of its net revenues that leads to 10.47% gain of the year. This highlights not only Goto's underperformance in operations, but also its inability to manage additional expenses, such as loss on goodwill, which further depends its financial struggles. Meanwhile, Bluebird's ability to generate income through other sources reflects better overall financial health and operational efficiency. Lastly, the other comprehensive income aspect. Goto has managed to achieve gains from other comprehensive income or OCI with a composition of 0.73% of its net revenues, while Bluebird experiences a loss from other comprehensive income, recording minus 0.02% of its net revenues. This shows a contrasting approach between the two companies in managing non operational income or expenses. Goto's positive gain from OCI indicates its ability to benefit from other financial activities, whereas Bluebird's minor loss suggests a greater vulnerability to unfavorable changes in non operational items. From this analysis, there are some points that needs to be highlighted. First one is that Goto endured a significant amount of total comprehensive loss, totaling in minus 611.48% of its net revenues, while Bluebird received a total comprehensive gain of 10.45% of its net revenues. Even though Bluebird is not as big and notable as Goto, it is able to manage its expenses better, leading to a more profitable company.
Okay, next is the vertical common size analysis for balance sheet for the current asset segment. From the segment, we can see that the biggest composition in current asset compared to total asset is in the cash and cash equivalent, time deposit, and other receivable third parties. The total current asset of PT Goto reached 62.14% of total asset. This composition shows that PT Goto has strong liquidity. Next, the comparison with Bluebird. The biggest composition in Bluebird current asset compared to total asset is cash and cash equivalent, trade receivable, and then other receivable. In comparison, the Bluebird has only current asset of 19.75% of its total asset. This indicates that Goto has more asset that can be quickly converted in cash, making it better prepared to face short-term liquidity needs compared to Bluebird, which focus more on long-term asset. Next is the vertical common size analysis for the non-current asset segment. From this segment, we can see that the biggest composition in non-current asset compared to total asset is intangible asset, goodwill, and other investment. This composition shows that PT-GoTo has a significant focus on intangible asset and goodwill, reflecting the company depends on intellectual property, technology, and the result of other business acquisition to support its growth. In comparison with Bluebird, the biggest composition in Bluebird non-current asset compared to total asset is fixed asset. Bluebird's non-current asset reached 80.25%, while Goto was only 37.86%. This shows the difference in strategic focus, with Goto relying more on digital innovation and intangible asset, while Bluebird focused on physical asset for its transportation operation. Next, from the current liability segment, the biggest composition in current liability compared to total liability and equity is other payable for third parties, accruals, and trade payable for third parties. PT GoTo total current liability, which amount to 23.70% of total liabilities and equity, indicate moderate and dependence on short-term debt to finance the company's operation. In comparison with Bluebird, the biggest composition in Bluebird current liability compared to total liability and equity is bank loans, trade payable for third parties, and accruals. PT GoTo relies more on third-party debt to fund its short-term operation. On the other hand, Bluebird relies more on bank loans, indicating a more traditional funding strategy through financial institutions. For the non-current liability segment, we can see that the biggest composition in non-current liability compared to total liability and equity is non-bank loans and deferred tax liabilities. PT GoTo's non-current liabilities reach 10.27% of total liabilities and equity, with the largest component being non-bank debt and deferred tax liability. These non-bank debts indicate long-term funding from sources other than bank, which help reduce the risk of high bank interest rate. Overall, we can see that PT GoTo dependence is greater on current liabilities than its non-current liabilities, indicating potential short-term liquidity risk. In comparison with Bluebird, the biggest composition on Bluebird non-liabilities compared to total liability and equity is bank loans and deferred tax liabilities. GoTo relies on non-bank debt as the largest component of its non-current liabilities, while Bluebird relies more on bank loans. This indicates that GoTo has greater flexibility in choosing funding sources, while Bluebird faces higher interest risk due to its dependence on bank. In contrast to PT GoTo, which relies more on short-term debt, Bluebird depends more on non-current liabilities compared to current liabilities. This indicates Bluebird is more stable in terms of long-term funding management, thus having lower short-term liquidity risk compared to GoTo. Last, in the segment of equity, we can see that the biggest composition in equity compared to total liability and equity is additional paid and capital and accumulated losses. PT GoTo has an equity composition dominated by additional paid on capital of for 461.77%, reflecting significant capital support from shareholders through the issuance of share at a premium price. However, with an accumulated loss of minus 386.21%, this shows that the company is still experiencing quite large operational losses. Currently, PT Gotos is still very dependent on equity capital to support its operation because it has not been able to generate profit independently. Okay. In comparison with Bluebird, the biggest composition in Bluebird equity compared to total liability and equity is return earning, unappropriate, and additional paid in capital. Bluebird's equity is primarily composed of return earning, unappropriate, and additional paid in capital. The large return earning indicates significant profit from operation, allowing Bluebirds to sustain uh, and grow by relying on internal resources rather than heavily depending on external funding. Currently, Bluebird is in a more stable financial position than Goto, which is with its ability to rely on self-generated profit, while Goto is still in process of achieving profitability and must rely on external capital funding.
For the operating activities on vertical common sense analysis, we have identified two major things. The first is negative net operating cash flow. GoTo faces a negative net operating cash flow, accounting for negative 17.83% of its gross revenue. This contrasts sharply with Bluebird's positive cash flow of 4.52%, underscoring GoTo's ongoing challenge in achieving profitability. The next is burden on operating costs. GoTo's customer receipts make up 97.89% of its gross revenue, compared to Bluebird's 19.97%. Furthermore, GoTo allocates 52.85% of its gross revenue to customer payment, a category not present for Bluebird. This indicates GoTo's strong reliance on promotional efforts. Despite comparable revenues, with GoTo at approximately 24 trillion 260 million rupiah and Bluebird at around 22 trillion 927 million rupiah, GoTo incurs significantly higher expense. Employee costs constitute 22% of GoTo's gross revenue, compared to only 1.74% for Bluebird, reflecting a heavy financial burden on GoTo from staffing and customer-focused expenditure. The net revenue are used for comparison as Bluebird's gross revenue are not disclosed in their annual report. From investing activities, we also identify two major things. The first is negative net investing cash flow. Both Goto and Bluebird demonstrate negative cash flow from investing activities, indicating that neither company relies on investing activities as a primary source of cash generation. The second is investment focus. Bluebird's investment strategy centers on purchasing fixed asset, allocating 6.08% of its revenue to this category. In contrast, Goto dedicates only 0.71% of its revenue to fixed asset, reflecting a lower emphasis on this area. Instead, Goto prioritized time deposit, which represent 9.17% of its revenue. Additionally, Goto allocates 2.57% of its revenue to loans provided to third parties, likely connected to its pay later program that offers customer loans, a feature absent in Bluebird's operation. The next is financing activities. There are also two major things that happen. The first is cash investing and financing focus. Both Goto and Bluebird allocate the highest percentage of cash invested to payment to third-party creditors, with Goto at 1.88% of its gross revenue and Bluebird at 1.99%. Goto's financing activities are primarily focused on issuance of equity-linked bonds, which account for 9.5% of its gross revenue. In contrast, Bluebird emphasized proceeds from loans, which represent 3.47% of its gross revenue. The next is net cash from financing. Due to its larger proportion of bond issuance, Goto has a higher net cash provided by financing activities at 7.14% of its gross revenue. This is significantly higher compared to Bluebird's net cash from financing, which is only 0.65% of its gross revenue. Part 4.4 Financial Ratios. For the financial ratios, this is the indicator that we use.
Okay, next is the activity ratio. From the activity ratio, we can see that PT Goto shows high operational efficiency compared to the industry and sector, especially in days sale outstanding, days inventory outstanding, and receivable turnover, reflecting efficient receivable and inventory management and strong cash flow. However, the low asset turnover ratio indicates opportunity for improvement in asset utilization to increase revenue. In addition, the higher days payable outstanding indicates Goto is extending its debt payment, GoTo main strength is its negative cash conversion cycle, indicating that the company is able to fund operation with minimal working capital, placing it in a very strong liquidity position.
From the liquidity ratios, GoTo's liquidity position in 2023 is exceptionally strong, as evidenced by its current ratio of 3.82 and quick ratio of 3.81, both of which far exceed industry and sector average. The current and quick ratios are nearly identical because GoTo primarily focus on service operations, where inventory plays a minimal role in overall operations. This indicates that GoTo is well equipped to meet its short-term financial obligation and manage its cash flow effectively. Additionally, the negative conversion cycle of negative 78.18 highlights the company's efficiency in converting investment into cash, enabling it to collect payment from customers before fulfilling its own liabilities.
The next financial ratio is the solvency ratios. So in 2023, Goto maintained relatively low debt levels compared to industry and sector average, as reflected in its debt to equity of 0.13 and total liabilities to equity ratios of 0.36. This suggests a level of financial stability and a reduced exposure to financial risk associated with high debt, such as rising interest rates or potential liquidity issues. However, despite this favorable debt position, Goto faces significant challenges. The negative interest coverage ratio of minus 13.23 and extremely negative free cash flow of minus 535 billions raise serious concerns about the company's ability to generate sustainable profits. These indicators highlight ongoing operational struggles and point to potential issue with cash flow management and profitability, making it difficult for the company to support its operating in the long term. Next, the profitability ratios. In 2023, Goto's profit margin of 49.59% exceeds both the industry average of 24.33% and the sector average of 20.03%. This indicates that Goto is effective in generating revenue and managing direct costs, suggesting that their products and services are well received in the market. However, Goto's financial ratios for operating profit margin and net profit margin are significantly below the industry and sector average, with negative figures indicating continued losses. This highlights a critical um, issues. While the companies can generate substantial gross profit, it struggles to translate those profits into net earnings. This points to a broader financial management challenges, including issues with capital structure, innovation investment strategies, and operational inefficiencies, which are preventing sustainable profitability.
From the valuation ratios, the industry shows a moderate level of profitability with an earnings per share of 2.67, while the sector performed better with a higher EPS of 5.59. In contrast, GoTo has significantly negative EPS of negative 71.49, indicating that it is operating at a substantial net loss compared to both the industry and sector average. The industry has a price to earnings ratios of 6, suggesting a conservative market valuation for its companies. The sector shows a slightly higher P/E ratio of 7.93, reflecting a more optimistic outlook for companies in this category. GoTo, however, has a negative P/E ratio of negative 1.12, primarily due to its negative earnings, making it an outlier and unsuitable for valuation using this metric. The next is the industry demonstrates a market to book ratio of 3.1, indicating that its companies are valued at over 3 times their book value. The sector's market to book ratio is slightly lower at 2.63, suggesting that it is undervalued compared to the industry average. GoTo's market to book ratio of 2.8 is closer to the sector average, but still lower than the industry benchmark.
Moving on to the part 5 of this presentation, we're going to talk about the sustainability analysis. Talking about sustainability reporting, GoTo's sustainability report has been developed in line with internationally recognized standards and frameworks, including firstly, the Global Reporting Initiative or GRI. GoTo continues to use GRI's reporting standard as the primary reference for indicators, definitions, and requirements for each disclosure in this report. Secondly, the Sustainability Accounting Standards Board, or SASB. To improve the quality of its disclosure, Goto supplemented GRI's reporting requirements with SASB's sector specific standards for e commerce and road transportation. Thirdly, the Financial Service Authority Regulations, or POJK, in Indonesia to consistently ensure that its report remains within the relevant context of Indonesia and adheres to Indonesian regulation. Goto Sustainability Report follow POJK number 51 and SAOJK number 16. Fourthly is the International Financial Reporting Standard, or IFRS, in line with 2023 updates to the Task Force for Climate Related Disclosures, or TCFD framework. Goto have included EFRS Foundation's S1 and S2 standards in their report to ensure alignment with the latest on sustainability and climate related disclosures. And here's also some ESG topics in GoTo's 2023 sustainability report that can be seen in the diagram below. The ESG topics in GoTo's sustainability report consist of many variations, including environmental, good governance, business ethics, and employment practices. In regard to the case of recent major layoff, we want to delve into GoTo's sustainability effort regarding its employee as one of its stakeholders. One of Goto's sustainability efforts is empowering its stakeholders, which includes first, building a diverse workforce by increasing female representation, especially in senior leadership through signatory of the United Nations Women Empowerment Principle from 2020 with the goal of achieving 33% female representation in senior leadership roles by 2030. Next is development and training by using Goto's 360 performance review process to regularly conduct multi-way discussion on every employee's performance. Thirdly is that fair pay and equal rights by ensuring Goto employees are paid the applicable minimum wage at based on the respective government regulations, or also known as UMR, of its operation locations, and every employee has equal rights. Lastly is establishing DEI best practices by implementing zero tolerance for harassment and discrimination and establishing foundational DEI resources. From the various and comprehensive analysis that's been explained throughout this presentation, we've reached to the last part, which is the conclusion. We can conclude that the report on PT Goto Gojek Tokopedia TBK highlights the company's effort in 2023 to achieve profitability through aggressive cost cutting measures, particularly in technology related expenses, without resorting to further layoff. We divide GoTo's performance evaluations into its financial performance and non financial performance. First, from the financial perspective, GoTo successfully increased its operational efficiency in 2023, reducing total expenses by 39.86% and improving gross profit margins to 60.94%. Goto also continued to face losses, largely driven by non operational issues such as goodwill impairments and foreign exchange losses. Lastly, reliance on external financing continued to hinder profitability and pose liquidity challenges. Next, Goto also put big attention to its CSR, which Goto aims to achieve net zero emission by 2030, demonstrating a strong commitment to sustainability. Next, the company also empowers stakeholders by building a diverse workforce, conducting development and training, implementing fair pay and equal rights, and also establishing DEI best practices. Lastly, integration of this initiative with GoTo's core business strategy is vital to balancing social impact and profitability. Overall, we can conclude that based on GoTo's performance in 2020 to 2023, investors with high risk tolerance and long term perspective may find GoTo appealing given its growth potential and commitment to sustainability. However, investors looking for a stable investment shouldn't invest in Goto since the company is still struggling to make a profit and improve its cash flow. This marks the end of our presentation. We hope that our analysis could present an enlightenment regarding GoTo's current situation, both in its financial and non financial aspects. Thank you.